Welcome back to the Deep Dive. We're here to give you the key takeaways of the biggest earnings calls, cutting right through the noise.
And today, we're diving straight into Strategy Inc.'s Q3 2025 earnings. They've really cemented this shift into being a Bitcoin Treasury and, well, a credit platform.
And the market reaction. Pretty significant. Seems like investors are buying into the strategy.
Oh, absolutely. There seems to be strong consensus, judging by the reaction.
So let's hit the numbers first. This quarter wasn't just a beat. It felt, transformative.
Yeah, transformative is the word.
The GAAP EPS came in at what, $8.42? The consensus was expecting a loss, like negative 0.11 cents. That's just huge.
A massive swing, yeah. Shattered the consensus. And revenue, also strong, $128.7 million.
Which beat expectations by merely 10%, right?
Comfortably beat them, yeah. And then you've got operating income at $3.9 billion, net income $2.8 billion. Big profits.
Okay, but wait. This massive swing to profit, it's almost entirely down to one thing, the accounting change.
Pretty much entirely, yeah. Adopting fair value accounting for their digital assets, their Bitcoin holdings. That's the driver.
Right. That change added something like $18 billion to the balance sheet.
Approximately, yes. It massively strengthened the balance sheet. And it marks the second straight quarter of positive GAAP earnings, so there's a pattern forming.
And the key metric, the one they seem to live and breathe by now.
Their Bitcoin holdings. They now hold 640,808 Bitcoin. That's the core asset.
Okay, so let's dig into the strategy and the metrics that really matter for this Bitcoin native model they're building.
Well, management was very clear. The goal is amplifying shareholder value by increasing Bitcoin per share. That's their yardstick.
Bitcoin per share accretion. And how's that trending?
Upwards. It increased again this quarter to 41,370 Satoshis per share.
Wow.
Yeah. And that continues a trend. They said it's up 3.5 times since they started this whole Bitcoin strategy back in 2020.
So the idea is they're acquiring Bitcoin faster than they're issuing shares to pay for it, basically.
Exactly. The capital raising and conversion flywheel seems to be working very effectively. And you see it in the yield, too.
The Bitcoin yield.
Yeah, year-to-date Bitcoin yield is 26%, which in dollar terms is a $12.9 billion gain just from holding and acquiring Bitcoin this year.
Okay, so the balance sheet is clearly driving the headline earnings. But what about the legacy software business? Is that just forgotten?
Not at all, actually. It's providing a stable base. Subscription services revenue grew 65% year over year.
65%. That's pretty strong growth.
It is. And it's still maintaining a solid gross margin, around 70.5%. So that part of the business is, funding operations and contributing nicely.
Right. Provide some foundation. Okay, that's the performance.
Yeah.
But investing is always about the future. What about the outlook? You mentioned aggressive guidance earlier.
Extremely aggressive. They explicitly reaffirmed their full year 2025 guidance.
And what does that look like?
Well, if their key assumption holds, they're projecting diluted EPS of $80.
$80. Hold on. The street consensus before this was around 18, right?
Yeah. Around $18.25. Yeah. So $80 versus $18. That's a massive difference.
And that implies what? $24 billion in net income and $34 billion in operating income.
That's the projection. But again, it all hangs on one critical assumption.
Which is?
They were very upfront about it. This guidance assumes Bitcoin ends the year at $150,000.
Okay. $150,000. That's certainly a variable, a big one.
A very big one. If Bitcoin doesn't hit that mark, say it ends the year at $100, those EPS numbers come way, way down.
So that divergence is absolutely critical for anyone looking at this stock. The sensitivity to the Bitcoin price is enormous because of that fair value accounting.
Exactly. The P&L magnifies Bitcoin's volatility, but, and this is important, their capital raising mechanism, the credit platform, is designed differently.
How so?
It's structured to be lower risk, less volatile than the common stock. The idea is they can keep issuing their preferred equity, keep raising capital, even if the Bitcoin price is choppy in the short term.
Right. Okay. That brings us nicely to the engine room then, the digital credit platform. That's how they're funding all this Bitcoin buying.
Precisely. They've raised nearly $20 billion year to date through capital markets.
Mostly through preferred equity now. They're moving away from convertible debt.
That's the strategic shift, yeah. Towards perpetual preferred equity, they launched 4 specific preferred securities this year alone: STRF, STRK, STRD, and STRC.
And STRC, the stretch one, that was apparently the biggest U.S. IPO of 2025 so far.
According to them, yes. And they're actively managing the dividend on it. They just announced an increase effective November 1st.
By how much?
Another 25 basis points, taking the dividend rate up to 10.5%. And they use a rules-based framework tied to trading volume, the 5-day VWAP, to set it.
10.5% yield.
Okay.
But you mentioned something about a killer app feature, the tax efficiency.
Oh, yes. This is probably the most unique aspect of these preferreds. The dividends are structured to be taxed as a return of capital, or ROC.
ROC. Okay, break that down. Why return of capital, and what does that actually mean for an investor?
It comes down to the company's taxable earnings. Because Strategy Inc.'s core strategy is buy and hold Bitcoin, they don't sell it and realize taxable gains.
So they have huge unrealized gains on the balance sheet, but low or even negative taxable income.
Exactly. Under tax rules, if a company doesn't have sufficient current or accumulated taxable earnings and profits, the distributions it pays out aren't taxed as dividends in that year. Instead, they're treated as a return of the investor's original capital.
Which means the tax is deferred.
It's tax deferred. You don't pay tax on that income until you sell the security or until your cost basis goes to zero. Management suggested this deferral could last potentially for 10 years or more.
Wow. Okay, that is a massive advantage compared to, say, a corporate bond where you're paying tax on the interest every year.
Huge advantage. They gave an example, that 10.4% effective yield on one of their issues. For a U.S. investor in a high tax bracket, that's equivalent to earning about 16% on a fully taxable instrument.
16% tax equivalent yield.
Yeah.
No wonder these things are popular.
It makes them incredibly compelling, especially in the current environment. That tax-deferred yield plus the Bitcoin collateral backing it is a powerful combination.
So the ultimate goal of this whole sophisticated credit strategy, it's about something they call amplification.
Right. Management was very specific. They want to drive financial leverage, traditional debt down to zero. They currently have about 11% leverage. They want zero.
Zero debt, okay.
But at the same time, they want to drive amplification up. It's currently around 21%. They're targeting 30% or more.
And amplification is using the preferred equity to buy more Bitcoin.
Essentially, yes. It's using that lower risk preferred equity capital to acquire more Bitcoin per common share. It increases the Bitcoin exposure for common stockholders without using risky debt. That amplification is what helps drive the premium the common stock often trades at compared to just the underlying Bitcoin value, the NAV.
Got it. Okay, shifting gears slightly, let's talk investor context. They hit a milestone recently with credit rating.
They did. They received a B issuer credit rating from S&P. Now, B is still technically high yield or junk territory.
But for a company whose main asset is Bitcoin, getting any rating at all is significant.
It's a huge first step. Management believes this rating will start to open doors to institutional investors, pension funds, insurance companies, many of whom have mandates that require investments to be rated.
But there was a catch, wasn't there? Something about how S&P actually calculates that rating.
Yeah, a key headwind. The current S&P methodology basically penalizes them heavily for holding Bitcoin. They deduct the full value of the Bitcoin holdings from the equity side of the calculation.
So the very asset that defines the company hurts its credit rating under the current framework.
Kind of ironic, isn't it? Management said they're actively working to educate S&P and the market on why Bitcoin should be treated differently as a capital asset. They're also hoping for changes in broader frameworks, like the Basel rules for banks.
Makes sense. Okay, what about external factors? What tailwinds are they seeing that might help that optimistic $150 Bitcoin target?
They pointed to several signs of increasing mainstream financial institution adoption. Morgan Stanley apparently dropped restrictions on clients buying crypto. Citi launched coverage and custody services. JP Morgan is now accepting Bitcoin and Ether as collateral for loans.
So the big players are getting more involved.
That's the narrative. And they also mentioned that the average 2025 Bitcoin price target among the banks covering them is now $156,000.
$156K. So their $150K assumption isn't totally out of line with Wall Street consensus then.
It's right in the ballpark, yeah.
And internally. Any big catalysts they're eyeing?
The big one is potential inclusion in the S&P 500 index.
Ah, right. Do they qualify now?
They believe they meet all the criteria. U.S. company, market cap liquidity, and crucially, those positive GAAP earnings for 2 quarters now, plus positive over the trailing 4 quarters.
And where do they rank by market cap?
They mentioned being ranked around hashtag 131 among U.S. companies, so well within the range.
And inclusion would mean?
Massive force buying. There's something like $13 trillion in assets that track the S&P 500. Inclusion would be a major demand driver for the stock.
Okay. And one last point on execution. They need to raise more capital soon.
Yes. To hit that 30% Bitcoin yield target for the year, they calculated they need about $2 billion more capital in the next 2 months.
$2 billion in 2 months. That sounds confident.
It suggests very high confidence in their ability to tap that preferred equity market quickly and efficiently whenever they need to. Their credit factory seems to be running smoothly.
It really is a fascinating model they're building. Okay, let's move to the segment everyone waits for. Time to put on our speculative hats for the "this is not financial advice" trade idea.
All right, let's have some fun.
Based on everything we heard in the call, the structure, the market context, what's an outrageous but maybe plausible trade that emerges?
Okay, here's one. It's a pair trade. The idea is you go short the common stock, MSTR, which is designed to capture the volatility.
Right, the amplification vehicle.
Exactly. Short the volatile common stock. And simultaneously, you go long the very first euro or Canadian dollar denominated preferred instrument that they issue.
Interesting. Short the common, long a new foreign currency preferred. Why specifically a foreign one?
Because management confirmed they plan to launch these native currency products, CAD, EUR, soon.
Yeah.
This allows international investors to buy in without taking currency risk.
Right.
And the rationale is pure arbitrage. Think about that 10.5% tax-deferred yield. In places like the EU or Japan, where interest rates are incredibly low, that kind of yield is almost unheard of. It's potentially quadruple the equivalent tax-adjusted yield available locally.
So the bet is that international investors starved for yield, especially tax-advantaged yield, will absolutely pile in these new foreign currency preferreds the moment they launch.
That's the bet. You expect the IPO for the first EUR or CAD preferred to be massively oversubscribed. So you capture a potentially rapid lower volatility gain on that new preferred as demand swamps supply,
while hedging the crazy swings of the common stock through the short position. A bet on global credit arbitrage driven by tax efficiency.
Precisely. Lower volatility entry into the Strategy Inc. capital structure, betting on the guaranteed success of their next capital raise internationally.
That is definitely outrageous but plausible. Okay, let's quickly recap this whole deep dive. The main takeaway seems to be Strategy Inc. is running a really disciplined, capital-efficient machine.
Yeah, a flywheel. Issuing this unique tax-deferred credit to constantly acquire more Bitcoin, amplifying the exposure for their common shareholders.
Successfully executing so far.
And that brings us to the final provocative thought for you to chew on. Management is adamant about avoiding debt, aiming for zero leverage, yet they're targeting 30% or more amplification using these very sophisticated perpetual credit tools.
So the question is,
are we still just looking at a Bitcoin treasury company? Or are they actually positioning themselves as maybe the world's first true digital structured finance entity, using Bitcoin as the base asset for a global credit operation?
Digital structured finance. Definitely something to think about as you process all this. We'll catch you on the next deep dive.